Hey everyone, I'm Connor Hallahan, and I'm the co-host of Silicon Street, a podcast on venture capital, technology, and entrepreneurship. We're geared specifically towards college students and young professionals who are looking to learn more about the industries we cover. So if you're a newcomer and are just trying to get your feet wet, you're definitely in the right place. Today, we're going to cover the basics of private equity. And to do that, we have a guest coming on by the name of Doug Brody. He's a managing director at KKR, which is one of the largest private equity firms in the world. Specifically, it's in the top three for assets under management, which basically means a lot of people give them money to invest. For this interview, we're going to cover three main topics. First, what is private equity? Second, what are the key metrics that KKR and Doug look for when they are trying to decide if they want to invest in a company? And third, we're going to look at what a leveraged buyout is, or an LBO. It's a type of transaction that a lot of private equity firms use in order to buy out these companies. So with that as a frame of reference, let's jump into the show.
We've interviewed partners and co-founders of various VC firms and growth equity firms. Can you just explain to our listeners kind of what role you think private equity has in the buy side industry, and could you explain to everyone kind of how it differs in both its strategy and its stage when compared to those earlier stage investors?
Sure. Yeah. One thing I'd start with maybe your listeners is a lot of them, especially those studying corporate finance, will be familiar with the difference between primary and secondary capital. Primary capital is obviously new capital being contributed to a business. Secondary transactions are one owner is purchasing ownership interests from another owner. And what you tend to see on the spectrum, and this is one of the differences between kind of VC growth, late stage, and then private equity, is that for the most part, a lot of the VC stuff that you see is going to be primary capital that's going to go really be the building blocks for starting some new businesses. As you move kind of into kind of growth and late stage growth, you're going to see a little bit of a mix of both. And that continues on in the when you get to larger cap private equity, where again, mix of both, but maybe you may see more of those transactions being secondary in nature. That's kind of a natural thing because at the outset, you need to capitalize these businesses to help them grow. As they mature and become larger, then they may be basically producing the capital themselves that enables their growth. And so what businesses need as they mature sometimes is less new capital and more new ways of thinking about approaching end markets, approaching go-to-market strategies, approaching the way that they think about their cost structures, and some more of the operational initiatives. And so when I think about earlier stage capital, I tend to think of smart investors backing smart entrepreneurs to get their businesses off the ground. As you move across the spectrum into later stage, more mature, typically what private equity does, I tend to think about smart investors purchasing controlling interests and really having a very operational, hands-on approach to improving businesses that are already reasonably mature.
Got it. Yeah, no, it makes a lot of sense. And then so we want to talk about like the main goal of private equity outside of generating above average returns. When you're looking at making investments, and I know you're on more the fund procurement side for KKR, but could you speak to some of the key metrics that KKR like looks at examining when prior to making large investments?
Yeah, for sure. So you kind of mentioned it to start, but like, what are we really in business to do? For the most part, sovereign wealth funds and pension funds that invest, teachers and firemen's pensions entrust us with money, intending to get more in return. And so, our overall, if you look at like our mission statement, it is to sustain and grow the kind of intergenerational capital of these pensions and sovereigns, et cetera. How do we do that when we actually get to a transaction itself? Different deals are going to require different things, but what are we looking at? We are looking at, when we look at a business, we're looking at what is the On the financial side, we might be looking at things like what portion of the market does this business control, and are they set up to be a net taker of share going forward, or a net loser of share? What are the pricing dynamics in the end market that they service? What's their customer concentration? What are kind of some of the existential threats to this business, be it regulatory, ESG related, or other? And we could spend a lot of time on ESG, but it's becoming, ESG started as a kind of nice to have, and now it's, I think there's really a concept of doing well while doing good. Businesses with a positive ESG story are going to outperform businesses that don't. And so that's something we spend a ton of time on. Obviously, from a financial metric perspective, we're looking at a business's ability to withstand leverage that we put on the business. We're looking at a business's ability to trade when we exit it. Usually we use EV to EBITDA. That's kind of our traditional valuation metric. That's not always the case, and in some industries you may have some adjustments to that. Like you may think more about EV to EBITDA less CapEx. It just depends on the nature of the business. But these are, at the end of the day, you're kind of looking at the nuts and bolts. What are the margins? Where is there room for improvement? What's the growth trajectory on the top line and on the and on the EBITDA? So it spans from these kind of operational pieces to these very financial ones in nature. And the fun thing I think about private equity is that you not only are you, if you're a long only mutual fund analyst, you can be really smart about evaluating a business and trying to project where it could go. The fun thing about private equity is you get to evaluate it, come up with a game plan as to what you want to do while you own it, and then go.
Yeah, that makes a lot of sense. And I know you just touched upon kind of the key metrics that goes into the actual investment process, but a lot of the returns, obviously, from a private equity firm come from the actual operational improvements that are made. So could you maybe talk a little bit about how those operational improvements are made? I know sometimes you might say bring in a new executive team or something like that, but could you just elaborate on what that process looks like?
For sure. Sometimes you find a great business with a great management team, where we can just be supportive and helpful as they enter new strategies or regions and help them grow. And we're sometimes investing behind a CEO, where we think she's just an incredible leader. She's driven this business before, and we can support her growth with capital and with our expertise and relationships. And in those scenarios, that may be, introducing that CEO to our other couple hundred portfolio companies that could be interesting partners of hers. That could be, helping if a business is planning a major overseas expansion, that could be introducing her to our geopolitical team that has relationships in those regions. So sometimes it's taking good and helping make it better. Other deals, we're buying very challenged businesses. We might be, one type of deal that we love is the corporate carve out. I think you guys probably think about LBOs and think a lot about public to privates, so full leverage buyout of a public company. A different style of deal is called a corporate carve out, where we're buying a division out of a big corporate or a big conglomerate. And the nice thing about those deals is that you may have an underlying business where the markets are fundamentally sound, but for whatever reason, it was a non-core business inside the inside the corporate that it was in previously. Maybe it didn't have the best management team. Maybe it wasn't getting the most focus from senior leadership. Maybe there were some things that had been overlooked for a long period of time. So what are we doing there? We could be thinking about fundamentally changing maybe the Salesforce incentive plan. How do we actually push the product to market? We could be thinking about how do we price their products. We could be thinking about are there redundant layers of management overhead. Sometimes you go into a situation and you say, we can't even figure out what all these people are doing at the manager level. That could be there. You could be looking at where their distribution centers are. Is there a footprint consolidation opportunity to lower costs? I do think it's at this point worthwhile saying private equity obviously has had various perceptions in the press, in academia, as to the social impacts of private equity, negative and positive. Private equity firms buy companies and often do eliminate positions. Private equity companies also buy companies and grow their employee base. So I don't know in the industry across the whole, but KKR, I at least know, has been a net creator of jobs. So when you improve businesses and make them better, you're going to create jobs. They may not be the exact same jobs that were there previously, but you're creating jobs. Now, that's not to say we don't get it wrong occasionally, and there's some pretty noteworthy examples of getting it wrong. And those are tough outcomes. Like, it's all good when you're in the office modeling out on a spreadsheet, but when a business goes bankrupt and everyone loses their job, that's a really bad outcome. But I think it's worth keeping in mind that A, we're net creator of jobs, and B, everything that we're doing, like, you got to remember who we're doing it for. Are the people that benefit are effectively the pension funds that invest in us. Not obviously, as you guys know, the executives within the private equity firms are compensated as well. So it's not a charity. But that just came to mind when we were talking about the kind of some of the operational stuff that we do. But we really there was a time of kind of corporate raiders, and I think we've evolved well past that as an industry. I think that we are very focused on growing and being a part of an evolving economy.
All right, everyone, that wraps up our interview with Doug Brody. We really hope that helped you get a basic understanding of what private equity is, what some of the dynamics are in the actual investment process, and the operational process of making the company better over time. I think that should give you a basic understanding of what PE is. We're going to have some future videos where we talk about things like growth equity and what venture capital are. So if you like this video and you're interested in learning more about that kind of stuff, please give us a thumbs up and subscribe to our YouTube channel.